Thank you so much for that warm introduction. And it's been a nice, interesting session today that we begin with. And the two core areas that we're going to cover today at the end of the session, hopefully, it's going to be a knowledge sharing session. So at the end of the session, hopefully, we're going to learn more about what are the principles of sound lending. And the focus here would be on a pre-sanctioned due diligence. As Dr. Sachdev has just said that, it's all about gatekeeping. It's all about credit selection at the very first instance. So we have to be first time right when we are going ahead with credit selection. So hopefully this will be a very useful session for all of you there. So just to give you a background into why we are talking about uh, principles of sound lending, why we're talking about due diligence is that all of us know that 70% or 60 to 70% of a bank's balance sheet is made up of your loans and advances. If you see, almost 80-84% is your interest income. That's the key chunk of revenue that's coming from your interest income. So the gross NPAs over the years has, they've been fluctuating, and this directly hits your bottom line. So we all profit-making banks, they are shareholders. Banks need to give returns to the shareholders. They're using public money. And this is where it's so very important to build a quality loan book. And I repeat, when I talk about quality loan book, without jeopardizing business growth. We all have business targets, right? So nobody's saying don't do business. The whole idea here is to do business which is good. So we have to build quality assets, and if it's done at ab initio, the very first stage, we're going to reduce this GNPA or the NNPA levels which are there. So of course they have come down. By March 22 they were around 6%, but yes, there has been something called PCR, which is the provision coverage ratio of scheduled commercial banks, which has gone up to about 71%. Right? So RBI increasingly is doing a lot on that banks need to have a high PCR. These were the dirty dozen, the 12 accounts which were identified by the RBI under the IBC code. And these 12 big accounts accounted for or constituted almost 25% of the NPAs of the banking sector. So they actually hit it. So what we need to do is, because loans and advances are a major chunk of the total bank's balance sheet, the biggest risk that bank face is your credit risk. What is credit risk? It's the default risk. When today you and I as a banker need to lend, what are we concerned with? The money that we are lending comes back in full and on time. That's the only two things, in full and on time. And this is greatly impacted by two things. One is what is the ability of the borrower to pay and the willingness to pay. If there is, either of these things goes down, there might be a default, right? And therefore, there might be an NPA, and therefore the profitability gets hit, right? So through an informed and sound lending, bankers can mitigate this risk. So you may have the ability, but you may not have the willingness. The infamous Kingfisher Airlines, the Malia case was one of this, that he was having probably the ability to pay, but not the willingness to pay. And that is why he was identified as a willful defaulter. Maybe to some extent, a Nirav Modi case as well, right? So as per BIS, the main causes of credit risk would be lax credit standards, poor portfolio management, economic changes that may lead to credit deterioration. Now, if you look at the first two, these are something to some extent in our hands. We as gatekeepers, or we as going in for credit selection, can look at these credit standards and poor portfolio management, right? So here, this is where we can play a role. So there could be reasons like, there could be economic changes because of which the business has gone down, and because of which there can be default, right? So that's okay. Certain things would not be in our hands. But if there is something called a quick mortality, when I say quick mortality, I'm talking about an account turning into NPA within, let's say, 1.5 years of onboarding. Then somewhere the question comes, was the correct credit selection right? So you see on the right hand side, all these Yes Bank, DHFL, all these banks, financial institutions have one thing in common. somewhere, you know, something happened and they turned bad, right? The accounts, maybe it was a big chunk of money given to a particular borrower. So there was credit concentration risk that comes in your poor portfolio management, or some kind of a lax credit standards. So with this background, let's all begin with today's first topic, which is on the principles of sound lending. Now, this may sound deja vu or cliche to all of you, but from my experience, what I understand is that credit is all about how much time you spend in analyzing the borrowers, how many cases that you have processed. The more variety of cases, the much better it is, because it's all comes with experience, right? And sometimes you need to go back to the basics and revise and rewind what we are, you know, sometimes in the horde of just giving out money, we may forget that.